hard times to good times. I am your host, Jay Taylor, and I'm speaking to you from New York City on this, the 29th day of January, 2019. Also, like to always remind you that I'm the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and the focus is largely on the junior mining sector, and I'm getting quite excited now, actually. I think finally we're going to make some money this year on the junior sector, and we could do very well. Usually when gold is hot and gold shares are hot, they're very hot, and when they're cold, they're very, very cold. And we've had a couple of years of quite a lot of cold, so I'm looking forward to what seems to be a turning point for the gold sector. We'd also like to remind you that Chen Lin's letter, What is Chen Buying, What is Chen Selling? ChenPicks.com is the place to go for that. ChenPicks.com has an excellent track record, especially in the biotech sector. And Michael Oliver as well. We'd like to remind you of Michael Oliver's great work, and he'll be talking to us in just a moment. OliverMSA.com, OliverMSA.com. Thank each of you for listening to this show, and would urge you to, or encourage you, if not urge you, to send along your comments, criticisms, praises, comments of any kind to questionsfortaylor@gmail.com, questions, the number 4, Taylor@gmail.com. We do want to thank our sponsors for making this show economically viable. Our sponsors for today's show are RN Resources, Novo Resources, Triumph Gold, Gold Mining Inc., and Uranium Energy. The title for today's show is How True Gold Price Discovery is Denied Citizens and Why. Chris Powell, Michael Oliver, and Amir Adnani are the guests for this week. In 1971, President Nixon defaulted under the U.S. obligation to pay foreign central banks 1 ounce of gold in exchange for every $35 paper dollars. In truth, the dollar was no longer as good as gold. To maintain its value, the U.S. arranged with Saudi Arabia and OPEC to require that all oil exports be paid for in U.S. dollars, thus enabling the U.S. dollar to engage in what I believe very strongly was an immoral act of printing trillions of dollars of fraudulent money to fund America's endless wars and socialism. The gold price has risen, but only partly in line with dollar debasement. Chris Powell will explain how true price discovery for gold has been denied by suppressive central bank manipulation and why it should matter to you as well. Notwithstanding gold price suppression, Michael will explain why a serious breakout in the gold price is now underway, and he'll be explaining that to us momentarily. And for the first time in many years, the uranium price is on the rise and seems to be, it actually has broken out. Michael's talked to us about that as well. That's why I had scheduled Amir Adnani to talk about uranium energy, but I was speaking with Amir a little earlier today, and noting the gold breakout, he suggested maybe he'd rather speak about Gold Mining Inc., which I think is an excellent idea because Gold Mining Inc. has, during the downturn, has assembled millions of ounces of gold from various properties. It's an options play on gold, and at some point, people are going to wake up to the enormous amount of gold that company has in the ground. And the options plays, once you get past a certain level where those ounces in the ground become profitable, all of a sudden those kind of companies can rise very dramatically in price. And so I think I'm looking forward to hearing what Amir has to say in the second segment of today's show. But right now, I'm happy to tell you that Michael Oliver is with me once again. It's OliverMSA.com, OliverMSA.com. Thanks for joining me again, Michael.
Hi, Jay. Always good to be back.
Always good to have you, and especially it's good to have you when times seem to be turning in our favor with a bit of wind at our backs for us gold bugs. This past weekend, you put out a missive on gold in an article headed 32 days and counting, meaning that in 32 days, I guess I'm not sure exactly what it meant. I took it to mean in 32 days from Saturday or from Sunday that we would reach a 5-year high for gold. But in fact, I was talking to you off mic, and you were suggesting that no, it's not 32 days from now. It's about 18 days or something like that. Could you tell us how you've come to the conclusion that we're ready to start knocking on the door of a 5-year high?
Well, if you look at a gold price chart, let's say a monthly bar chart, go back to the top of 2011, you'll see that since 2014, the high each year is gradually descending. The high in 2014 was just above 1390. Then we had highs in the 1370s in 2016. And we had highs in the 1370s, 60 level in 2017 and 18. So very gradually declining line, almost flat across going back 5 years, 14, 15, 16, 17, 18. Okay, now anybody can see that. And in fact, that's what the price charters are looking at. It's a big breakout if you get up there, and I say 1360 is enough to break it out. Well, you can wait for that if you want, but our momentum work, after the August low, which was down at 1161, we crossed 1200, we had our first breakout. Crossed 1240, it was December 7th, we had our second breakout. And our final breakout was crossing 1280 and later in December. So average price is 1240 on this upside here. Those were major momentum breakouts going back a couple of years in particular. That 1280 breakout, which is in December, took out the last thing we had in terms of resistance or a breakout level overcome. Now we're left only with price. So the price guys throughout the world, even those who don't like gold and never have gold or gold miners in their portfolio, are now getting phone calls, no doubt, from people, their subscribers, shareholders, and so forth, that how come we don't have any gold? It's the best performing thing out there for the last 3 to 6 months. You know, and they're waking up to it. It's been a sneak attack by gold.
Yeah.
The gold rally from August low of last year was arm wrestling type of move. It wasn't vertical. It wasn't rapid. It was just gain ground, held ground, gain ground, held ground. And it's behaved very well. Like there's some big bidding under the market, very solid. It doesn't back off much. Now I think we're about to accelerate. Getting over 1,300, right now we're 1,310 on the spot futures contract, Fed Gold. We're 3.8% away from what I think is the level that the price guys throughout the world will have to wake up and say, golly, you know, we either have to be in this or not be in it. It's time to have a committee meeting. And I think once that happens, once you get people who are non-gold people suddenly realize that it's the best performing thing out there, versus the S&P, even versus T-bonds, which is the other alternative that most people look at when they exit the stock market, they're going to be forced into it. Now, that will widen, I think, the demand base for gold miners. I had a somewhat sarcastic analysis of the gold miners for the past few years as sort of a private club of gold bugs who sort of like play cards with each other. In this case, they trade back and forth amongst each other. It's a very small sector in terms of size, billions of dollars in assets, et cetera, compared to, let's say, technology or consumer discretionary and so forth. So some of that money fleeing the stock market, just a small portion of it says, hey, we got to be in the gold arena. And they can't buy gold, let's say, so they buy gold stocks. That would be a huge rush of money into what's a small market arena, and I think it will create dynamics that you haven't seen in a couple of years. We still believe the gold miners will beat gold, hands down, in terms of percentage gain. Gold's the mama, and the gold miners are little dogs on a leash, but and they rush forward and they rush backward. You know, like you said, they underperform and outperform. But going forward on the upside here in gold, I think the miners would be the place to be, probably the best place on the planet.
Michael, where is that 5-year high for the bullion? What price are we looking at?
That would be the 1390 plus high that occurred in the 2014 high. But actually the line that's important is the one that comes across those highs and intersects now such that if you hit 1360, you're at the line, and believe me, they're not going to stop at it. I think they'll vault through that level, and you'll have gold in the 1400s rapidly. So, but the issue is the ambush effect that I think is about to occur, namely no more incremental firm upside. Now we vault upward. So it wouldn't shock me in the next week or so that we get a $40 day here or there. You know what I mean? So suddenly where there's a grabbing sound, people grabbing for that market, simply because there's nothing else performing the same way. Find me a commodity that's behaving like gold.
Okay, so we're looking at mid-February sometime, thereabouts, Michael?
Well, no, I think it could happen any time. I just had made a bet on December 7th. We put out a ridiculous report that said in 50 trading days, not market calendar days, gold will be above the 5-year highs, meaning take out the trend line that connects them plus that highest high up there at 1390 plus. And I think that's likely to happen. And I think now we're in the 1300s. We should see some more rapid advance. Not $5 days, but maybe we get a $30, $40 day in here, where the money flow suddenly pushes gold through that structure, the price chart structure, in a rapid way.
As Doug Casey called it,
is over.
As Doug Casey called it, a Niagara Falls through a garden hose.
Something like that. That's
Michael, what about some of the other markets then? What about Treasuries are looking strong now? It seems the market has gotten a bit weak, equity markets, so risk off going to Treasury, maybe to gold too, though, perhaps.
Yep, no, I think it's the two. I think it's gold, which has not been jolting higher, but T-bonds, if you'll notice, we got bullish in December last year.
Yeah.
Bonds came up to 141, T-bond futures. And they shot up. We thought we were getting a low 150s. They stopped just below 149. But then when we had this sharp stock rally, bonds pulled back into the 144. So they gave back half their gains. Mm-hmm. Still positive in our view. But during that time, if you'll notice, the other alternative, gold, did not break down. It stalled. It stalled in a very tight little fist of ink between 1280 and 1300. So unlike the bonds, which had a sharp pullback, as those who'd panicked into bonds as an alternative sold out when the S&P rallied, they didn't sell their gold. Gold held tightly, which I think is a good statement about the money flow into gold. But both of them can be viewed as alternatives to stocks for the time being. I don't think ultimately T-bonds will hold upside. I think we're going to have higher rates, but as the stocks break down sharply in those phases early in a bear market, you'll get these upward jolts in T-bonds, flight to safety again. Gold is the one that will persist opposite to stocks as the other alternative.
Well, we have seen at times in the past when risk has come out of, or when confidence is lost in the system, money comes out of both stocks and bonds and goes into gold. It doesn't happen all that often, but when it does, it can be very dramatic. And just one, with 30 seconds left here yet, soft commodities, you're still bullish on the agricultural commodities?
The place to be, aside from gold in the commodity arena, it's not so much the big name stuff like copper and oil, though they could get their act together again, too. They've had a big pullback, which we expected. It's the food commodities, the stuff that's basically priced out. It's blanched as much as it's going to be. They're not going to take it any lower. The issue is when it goes up. Speaking of things like sugar, cocoa, the grains, soybean oil, things that are mundane, stuff that comes out of the ground has been ground into, it's bottomed, and it's ready to participate in the upside. And I think that's where most of the commodity upside, broader outside of gold, that is, will be this coming year, will be in the food commodities.
Yeah. And I know that you also, your work is showing uranium looking pretty strong, too.
I like the uranium sector. It's had a fresh breakout back in October. It's gained since then, and I think it's a major breakout. I think it's a big turning point for uranium, which also got bombed out in terms of the price levels it saw in the recent years.
Yeah, and again, I would just remind my listeners that this isn't Michael just talking, just talking from the seat of his pants. He's looking at his momentum work and his, this is what I appreciate, Michael, about your work, is it's not just, I can look at various things and say, well, this seems like it ought to do this and that, it seems like it ought to do that. But in fact, subjectively, it's very difficult. It's very difficult to try to figure out what's going to really happen. But in those numbers, your work has just been so good. I want to thank you again for spending time with us and helping us along here. I went out and took a bit of a position in GDX this week through some call options, and they seem to be working well. And I did it strictly on your confidence, on the confidence I have in your work, that we're very near a very rapid blowout in gold, perhaps. So thank you very much, Michael, and I hope we can talk to you again next week.
Thank you, Jay. Bye.